Hey everybody, it's Andy with Overdrive Accounting, and in today's video I am going to be explaining how self-employed individuals are taxed. So, you received a 1099 MISC. Now what? Now, whether you're an independent contractor, a sole proprietor, or you have set up a single member LLC for yourself, they are all taxed the same way. You will report your income and your expenses on a Schedule C, which is part of your personal tax return. Okay, so the first step to do after you have received your 1099 is to determine your business deductions. So what can you write off? The IRS defines a business deduction as anything that is ordinary and necessary in order for you to conduct your business. So legal and professional fees, supplies, materials, office supplies, rents, anything that you have to spend in order for you to conduct your business qualifies as a business deduction. So another common deduction that self-employed individuals will normally take are expenses related to business vehicles. Now, with business vehicles, there are two ways that you can take the expenses. You can take the actual expenses, which would be your actual amount spent on things like repairs and maintenance and fuel, or you can take the standard mileage rate. The standard mileage rate within the actual rate is comprised of depreciation, repairs and maintenance, fuel, basically all of your business expenses. They just figure a standard rate for it that you would times the amount of miles that you drove in the year, and that would arrive at your auto expense. So if you take the standard mileage rate, you do not also get to expense your fuel or your actual expenses. It's one or the other. Now, the other portion of the standard mileage rate, or the vehicle expenses rather, would be to determine the amount of business use that you use the vehicle for. So if you have a separate vehicle that you use 100% of the time just for business, then 100% of the expenses related to that vehicle would be deductible. But if you are using a personal vehicle and let's say you only use it 80% of the time for business, then only 80% of the expenses or the miles would be eligible for the auto expense. And so it's really important for you to keep a mileage log, whether you use the standard mileage rate or not, just to determine the actual business usage of your vehicles. So another common expense that we will see related to vehicles would be the depreciation of the vehicle. So first step, it would be to determine the amount of business usage. Again, 100% usage would mean 100% of the cost of the vehicle would be eligible for depreciation. Now, if you're only using 80% for business purposes, then you would only be able to depreciate 80% of the vehicle. Now, depreciation is just cost recovery, which means that if you spend $10,000 on a vehicle, you would be able to expense the $10,000 depending on the type of depreciation method you choose, in 1 year or to 5 years, sometimes 7, depending on the type of vehicle and the class life that it would relate to. We'll get it more into depreciation in a different video. There's a lot that goes into it, but for the most part, all you need to know is that it's a cost recovery method, and that there are plenty of different methods that you can choose from. So that brings us to another common deduction, would be the home office deduction. Now, the home office deduction is figured when you have a room in your home that is solely used for business purposes. The idea, most people will use just an office, a small little room or a large room, depending on what you do. But it has to be solely used for business purposes. This is not something that you can, write off your garage and still store, all of your Christmas decorations or holiday decorations as well. It is very specific. It has to be solely used for business. But the way that it works is you take the square footage of that room. So let's say it's a 10 by 10 room, and then your entire home is 1,000 square feet. You would divide the business usage by the entire square footage of your home. In this example, would be 10%. So 10% of your utilities, your rent, your mortgage interest, your property taxes would be eligible to be expensed on your taxes. which would lower your taxable income. So, how are you taxed? So, there are a lot of misconceptions out there. What you need to know is you, as a self-employed individual, are only taxed on your net profit. So, you take your gross income, whatever your 1099, and then you take out all of the money that you spent in order for you to conduct business, take out your depreciation or your auto expenses, and then you will arrive at your net income. So your net income will be subject to income tax and then also self-employment taxes, which is the killer for self-employed individuals who are not prepared. Most of the time when I have people come into my office for the first time after they're self-employed, it is always the biggest eye-opener for them because they are normally not prepared for that tax. And what are self-employment taxes? You've all heard of them. The self-employment taxes are comprised of Social Security and Medicare. But the biggest difference now that you are self-employed is you are now paying the employer and the employee portions for a total of 15.3%. And that is computed afterwards. And I'm just going to show you a little example here of how much of a difference it does actually make, and if you're not prepared, how hard it can hit you. So you can see this little spreadsheet we have created just as a tax estimator for our clients. So in this example, we just have W-2 income for a married taxpayer. So $48,000 worth of W-2 income. After the standard deduction, we are looking at taxable income of $23,600, 12% tax bracket, for a total federal tax due of $2,444. And then this particular client would be a resident of Utah, so we figure in our Utah tax, which is another $2,376, for a total tax bill of $4,820. Now, if we take the same example, we plug in $48,000 worth of net profit for this taxpayer. It changes to the 10% tax bracket. So the income tax actually dropped, and the reason why is because we have the qualified business income deduction, which is a deduction for self-employed individuals, which lowered the taxable income. But then you can see here we had $1,400 worth of income tax, but then the self-employment tax, which is not figured based on the taxable income, but the net income from the business, which was $48,000. And this tax translated to $7,344 worth of self-employment tax, which increased the total federal tax bill to $8,744. Now, Utah, at the same time, computed another $1,900 worth of tax for a total tax bill of $10,644.80. So we had the same income, $48,000, but a $6,000 increase in total tax just because you're self-employed, because you are then subject to the self-employment taxes. Now, this is why it's very important for you to be prepared for these taxes throughout the entire year. I know it's tempting once you get that full paycheck and you didn't have any taxes withheld. You just need to be disciplined and realize that just because the taxes weren't taken out of that check, that they will be due later. That is one thing that you can guarantee. So if you have questions about your taxes, or you want to know more tips of how to be prepared and what you can do to lower your tax liability, go ahead, click the button down below. You can schedule a virtual meeting with us, and we will be able to get in contact with you and get a plan put in place so you don't have the surprise like this happen to you come tax time. So thanks for watching, everybody. Click the button down below. We'll get in touch with you. Thanks for watching.